The dollar index just hit the 99th percentile. And dollar strength at this level puts pressure on emerging markets and commodities. Something is breaking beneath the surface, and the data confirms it. Right now, the S&P 500 is at 7,500.6, the 95th percentile for the past year. Historically, the S&P at this level has historically marked a regime inflection. Snider says, the eurodollar system is tightening and nobody sees it. The dollar analyst says, the dollar will surge as global liquidity contracts, crushing everything else. In the next few minutes, I will show you who the data says is right and what it means for your money this week. The scoreboard just changed. A scoreboard flip means the numbers shifted. Pay attention to what moved and why. The commodity analyst is right, and the data keeps proving it. Oil at $75.8. 181-day streak. Snider's dollar liquidity crisis call is paying off. Yield curve at 0.27% and trending their direction. 3 days running, score 1 for the dollar analyst. Dollar milkshake higher. Gold agrees at $4,170. Gammon just moved from wrong to right. Gammon's credible blowout call is paying off. Investment grade spread at 74 basis points and trending their direction. Too early to call McElroy right or wrong. The thesis is building but not confirmed. 180-day streak. Too early to call Hartman right or wrong. The thesis is building but not confirmed. 174-day streak. Bad stretch for the volatility expert, for now. VIX at 18.4 says the opposite of volatility expansion. Score today, 4 right, 2 early, 1 wrong. When a speaker moves on the scoreboard, it means the data changed, not the opinion. That distinction matters. Today's big question. Everyone agrees on dollar, so who's wrong? Snider says, the eurodollar system is tightening and nobody sees it. The dollar analyst says, the dollar will surge as global liquidity contracts, crushing everything else. Everyone agrees. In markets, that is usually the setup for a reversal. The crowd is most confident right before the data breaks against them. Here is what the data says. The dollar index at 100.8, 99th percentile. Gold at $4,170, 42nd percentile, down 1.3% today. Bitcoin at about $62,000, first percentile, down 0.7% today. Bottom line, the consensus is bearish, and the dollar index at the 99th percentile says they might be right. But crowded trades unwind fast. If the dollar index breaks below 99, the milkshake theory loses its legs. Right now, it is at 100.8. If gold and Bitcoin both rally while the dollar holds, the liquidity thesis is wrong. The dollar index at 100.8 is in the 99th percentile, reversal territory. If it drops below the 75th, the thesis weakens fast. Gold at $4,170. We'll track it daily on the scoreboard. None of the 7 are talking about this next signal, and they should be. 2-year yield just surged 3.7% to 4.20%. A move this size demands attention. Historically, the 2-year at this level reflects where the market thinks the Fed goes next. None of the 7 are talking about this. Keep it on your radar. High yield spread just dropped 3% to 263 basis points. A move this size demands attention. Historically, high yield stress at this level signals institutional risk aversion building. And here is another signal flying under the radar that deserves your attention. Phase 1 is the good times, but good times do not last forever. Here is how close we are to the edge. We are 76 basis points away from Phase 2, the phase where credit breaks and volatility spikes. There is no acceleration in credit stress yet, but we are watching the pace, not just the level. The trigger, investment-grade spread crossing 150 basis points, currently at 74 basis points. Pace is flat or improving, no urgency right now. Phase 1 means risk on is working. Equities, commodities, and real estate all benefit from loose conditions. Enjoy it while it lasts. For context, the last time credit stress built like this, credit spreads blew out and high-yield bonds saw drawdowns of 15%. The credit and rates layer has CFNAI, equity risk premium flashing red. Snider says the eurodollar system is tightening and nobody sees it. The data agrees with that assessment. Phase 1 holds with 76 basis points of buffer. Conditions favor risk, but do not get complacent. Wall Street trades the index. We trade the ground. Here is what the ZIP level data is screaming about today. Monmouth, NJ, payment burden is past the breaking point. Allenhurst, NJ, median home about $2,441,000 on about $126,000 household income. Price to income ratio, 19.4. When the math stops working, sellers find out before buyers do. Cape May, NJ, payment burden is past the breaking point. Avalon, NJ, median home about $2,697,000 on about $142,000 household income. Price-to-income ratio, 18.9. When the math stops working, sellers find out before buyers do. Owsley, KY, lenders are saying no, at scale. In Owsley, KY, the HMDA denial rate is 86% across 50 applications. Top reason, credit history. Credit doors closing is the slowest, surest signal of a turn. These are not hand-picked metros. They are the loudest signals in the housing data right now, chosen by the numbers, not the narrative. Today's debate asked, everyone agrees on dollar. So who's wrong? Let me show you what happened the last time we were here. The dollar index at 100.8 is in the 99th percentile. That means it is higher than 99 out of 100 days in the past year. In 2022, dollar index hit 114, crushing emerging market currencies and commodities. In 2020, dollar spiked during the March liquidity crisis, then reversed on Fed intervention. In 2015, dollar strength crushed commodity exporters and triggered EM currency crises. Different environments, different catalysts, but every time, the resolution came fast. The pattern is not the level, it is the speed of the move once it starts. Meanwhile, Bitcoin at about $62,000 is in the first percentile. The last time both the dollar index and Bitcoin were at these levels simultaneously, the resolution came within weeks. That is why the scoreboard matters. It tells you which speakers saw it coming and which ones missed it. If history rhymes, Snider should be paying close attention because the clock is ticking on this pattern. Here's what the data says to do right now. Stay alert on VIX. It is surging 12.4% today. Fast moves demand attention. Avoid Phoenix at 41% payment burden. That is stretched territory. Watch 2-year yield. It surged 3.7% and nobody is talking about it. 4 out of 7 speakers are right. The commodity analyst, Snider, the dollar analyst, and Gammon. When this many align, the trend usually has legs. Every signal is live at analyze.builderslens.com. 7 speakers, 65 signals, 1 question every morning. Who's right? Subscribe, and I'll see you tomorrow morning.